We've already adjusted our portfolio strategies for what we deem to be a pretty volatile, challenging economy this year. We're not investing in a significant percentage of our portfolio and assets that are going to be subject to these type of tariffs. So, but there's no blanket. There's really no blanket protection because, in a way, tariffs, if, say, for example, they impact auto manufacturers significantly, so they're going to impact everyone else. Even defensive names, staples names, are going to be impacted by tariffs. So it really, we're doing our best to do what we can do to try to insulate portfolios. But this is something that's going to touch every area of the economy and every product class.
So you're saying basically there's no place to hide from tariffs, right? And from some of the notes that we're looking at here, it sounds as though you're actually saying, look, no place to hide, great, but just ride the wave. Is that a reason that you like financials on the view that prices, inflation, rates, and yields are going higher?
Yeah, I listed in the notes I sent into the producers about healthcare and financials and staples, and you're right. I mean, I suppose it's a little bit like, to use your ocean analogy, I think in those sectors the waves are going to be less violent. Yes, net interest margins tend to be helped as long as we don't go into recession for financial services. Staples are things that people buy whether the economy is great or not great. And healthcare, we all need to replace our knees and our shoulders and our elbows and every other part of our bodies that are failing, plus all the medications we need to take as an aging population. So I think at this point you can't really get so cute where you think I can avoid it all, because that really means exiting the market completely. And if you do that, then you're playing a timing game.
So, Michael, it's not just you, it's basically everybody, right? Who knows what's going to happen? And this whole situation of, leaving your money in cash or, money market and getting your 5%, even if it could change tomorrow, doesn't sound like that bad an idea.
Unless the market goes up. Then it's a horrible
lose out,
idea.
You're saying.
Then you're saying, think about this. Investors put $100 in, it goes to 80. They panic, they put it in cash. Then the market goes to 90, and what do? Do you bite the bullet and say, okay, I'll just buy it $10 higher? You're praying for it to go down. I mean, going to cash is not really defensive. It's really a strategy that in a lot of ways is actually predicting the future of the market, that it's going to go down. And I don't know anybody has the ability to do that with any significant accuracy. I think getting more conservative makes sense in economic times, maybe having a little bit more cash, a little more fixed income. But that full-on kind of in and out strategy, as I like to tell people all the time, you got to be right twice. And if you're right once, that's great. But I know plenty of people that got out right before the financial crisis and never got back in. And then 5 years later, it's the time to go back. Well, yeah.